Welcome to this explainer. Today, we're jumping right into the immediate choices, the hidden tax traps, and the massive macroeconomic math that permanently glues the stock and foreign exchange markets together. Whether you're an active trader or honestly just fascinated by the plumbing of the global financial system, understanding how these two gigantic markets collide is absolutely crucial.
So, think about this for a second. It's a fundamental question. If the stock market experiences a sudden violent crash, does the currency market actually feel the shockwaves? To definitively answer that, we've got to unpack the fundamental mechanics driving both of these systems.
And to find that answer, we have to look at the mechanics, the taxes, and the hidden math of global trading. Okay, let's start with the microscopic, everyday reality for an individual trader.
Forex is basically this raging 24/5 ocean of liquidity. We're talking a staggering $5 billion in daily volume just sloshing around continuously across overlapping time zones. The stock market, on the other hand, it acts a lot more like a scheduled, steady river with fixed daily hours and an architecture built around longer-term company growth.
But here is where it gets wild: the leverage and the massive risk that comes right along with it. In Forex, your margin rates can start as low as 3.3%. That hands you a massive 20-to-1 leverage ratio. Stocks, though, generally demand a much higher margin, usually around 20%, which capture leverage at 5-to-1. And this math directly dictates trader behavior, right? Forex naturally attracts that aggressive, short-term scalping, while stocks often favor the patient buy-and-hold approach.
Navigating the tax trap. The mechanics of a trade might be universal, but how the government treats your profit? Oh, that is fiercely local. Take the US, for instance. You face a pretty stark choice. By default, spot Forex falls under Section 988, so taxed as ordinary income up to 37%, but you do get the safety net of unlimited loss deductions. Consistently profitable traders, though, can proactively elect Section 1256 for a significantly lower blended max tax rate of about 26.8%. The catch? You have to make this election before January 1st. Seriously, there are no retroactive lifelines here.
Now, hop across the pond to the UK, and the instrument you choose changes literally everything. If you trade through spread betting, the UK basically treats it as gambling, meaning your profits are 100% tax-free. But if you execute the exact same trades using contracts for difference, bam! You're suddenly hit with a 10 or 20% capital gains tax. Same speculation, entirely different math.
Meanwhile, the EU landscape is completely fragmented. Germany takes a flat cut of about 26%, France uses a 30% flat tax but lets you opt into a progressive scale, and then there's the Netherlands. They operate on this totally unique Box 3 system. They don't actually tax your real trading gains at all. Instead, they tax you on assumed returns based on your total assets. It's brilliant if you're wildly profitable, but incredibly punishing if you hold a ton of capital with tiny returns. Okay, but here's the silver lining for us. No matter where you live, you can actively shrink your tax burden by aggressively deducting legitimate trading expenses. Running algorithms? Deduct your 24/7 virtual private server. The same goes for Bloomberg data feeds, custom software, broker fees, and even the proportional cost of your home internet. You've got to be careful, though. Those deductions demand immaculate accounting. Do not, and I mean never, mix your personal bank account with your margin deposits. It will turn a simple audit into an absolute nightmare. Plus, if you trade in US dollars but file your taxes in euros or pounds, you can't just ignore the exchange rates. Every single deposit, withdrawal, and realized gain has to be converted at the prevailing central bank rate on that exact day.
Market volatility and spillovers.
Let's zoom out from your individual tax return for a second and look at the big macro reality. There's some fascinating academic research looking at the Indian Sensex and Nifty indices alongside the Forex market, and they investigate something called volatility spillover. This is when sudden shocks in one financial market literally transmit into another, creating this measurable statistical echo effect. It's essentially financial contagion. To actually prove this, researchers bust out some heavy econometrics, specifically the EGRCH model. But translating that complex math into plain English, the equation proves that volatility transmission is asymmetric. It mathematically verifies that positive and negative news in the stock market doesn't just stay politely confined to equities, it actively shapes the variance of exchange rates. And building on that, the related Garch variance equation tracks these market shocks and reveals something even more vital. This transmission is bidirectional. It isn't just the stock market dictating terms to the currency market. Nope, shocks in foreign exchange echo right back into the stock market. So here's the sequence of how this hidden math plays out in the real world. 1. the domestic stock market gets hit with a sudden crash. 2. International investors are immediately forced to rebalance their multi-currency equity portfolios to manage the risk. 3. This massive global rebalancing fundamentally alters international currency demand. And finally, 4. The foreign exchange market reacts in tandem. The shock has officially spilled over.
The study concludes it perfectly. There exists a bidirectional volatility spillover, and both markets move in tandem. I mean, really think about what that means. Despite having entirely different trading hours, drastically different tax structures, and vastly different leverage limits, the ocean of Forex and the river of stocks are mathematically joined at the hip.
Which brings us to the ultimate takeaway for your wealth. If academic modeling proves these supposedly separate markets actually echo each other's panics, is your portfolio truly diversified? Knowing that the ocean and the river are permanently linked by global rebalancing, how are you going to protect your capital against the next major shock? Thanks for exploring the mechanics, the taxes, and the hidden math with me today.